Hi everyone, it's Ben Adams with the American Offset Mortgage, and welcome back to the channel. Now today we're going to continue our discussion on student loans, and what I'm going to talk about today is student loan advocacy. I don't feel like anyone is really advocating for the student, and that's one of the issues that I've always had with higher education and with student loans is there's no one really representing the student. Now, the analogy that I always use when describing this is, because I'm in mortgage and I'm in the real estate field, I go back to the housing crisis back in 2008. At the time, no one was representing the homeowners, and the analogy that I always use about that and what we learned from 2008 is that the homeowners, weren't educated on all of these loans. So if you'll recall, what caused this housing collapse nearly 15 years ago is that borrowers and homeowners were getting into these loans that they didn't understand. They were extremely high risk. They weren't being explained in a way where the homeowner had any idea what they were doing. Credit was simply just too accessible. A lot of times you didn't have to have a job to get a loan. You didn't have to have any assets. You could get 100% financing. Back in 2006, 2007, there were also loans that were negative amortization, meaning that you had options to pick how much you wanted to pay on your mortgage. And if you didn't pay the fully amortized amount, your mortgage balance could also increase. And so here's the concern that I have. A lot of that is still being allowed with student loans. There's no one, first of all, representing the students. There hasn't been any government reform been passed. So one of the things that we did learn from the housing crash 15 years ago is there was a lot of government reform that was passed. Now there are certain things that have to be explained in advance. There are certain deadlines, there are certain requirements that have to be met. Homeowners now have to demonstrate what's referred to as the ability to repay. And these are all for traditional Fannie Mae, Freddie Mac, FHA loans. And a lot of those other loans, those high risk, subprime, toxic loans, well, those don't exist anymore. But in the student loan world, all of that is allowed. No one is explaining to 18, 19, 20-year-olds how student loans work. No one is explaining what the risks are. And students a lot of times don't understand what the repayment terms even are or what the requirements are. And so that is one of my big concerns, is that no one is advocating for the student. And here's the deal. A lot of prospective students, they just don't have the life experience to understand how student loans and this financing works. A lot of them are just teenagers still. They don't have that life experience. They don't have any experience whatsoever paying bills or being financially responsible. And along those same 18-year-olds, they wouldn't be able to go to a bank and get a loan for a mortgage or a business loan. You know why? Because they wouldn't be able to demonstrate the ability to repay. Yet these same students who aren't educated on finances, who don't understand repayments, are allowed to take out tens or in some cases even hundreds of thousands of dollars without even understanding what the implications are. And here's what concerns me the most when it comes to student loans. You have an 18-year-old who is excited to go to school and go to college. A lot of times they don't have a plan and they don't understand what they're doing or why they're doing it. But the question that they're not asking themselves, because they don't have that experience, is what are these actions I'm taking today? How are they going to impact me 5, 10, 15, or even 20 years down the road? Because a lot of times student loans can linger for that long. When I talk about student loan advocacy, what I believe should happen is that someone needs to be representing the students. Someone needs to be able to educate these students on the pros and the cons of student loan debt, educate them on what the possible financial pitfalls are. And a lot of this is around financial literacy and what the opportunity costs are. Remember, financial literacy is not taught anywhere. I believe that it needs to be incorporated into our elementary education, junior high, and high school education, because it's that important. We also need to educate students on what is the opportunity cost, where if you go to college and you take out student loan debt, then you're not going to be working, you're going to be going into debt. What is the opportunity cost? So what else could you be doing if you didn't go to school? What if you went and you were an apprentice somewhere, or you got a job and you learned a valuable skill? Not only would you not be going into debt, but you'd be getting paid and you'd be learning the skill. And so we need to learn how to evaluate these things and compare the pros and the cons of going to school to, what are the other options? And just to put things into perspective, your average student who has student loan debt has anywhere from $40,000 to $50,000 after they graduate from their 4-year school and get that 4-year degree. $40,000 to $50,000. This isn't chump change. And did you know that over 2.5 million students have over $100,000 in student loan debt? And this is another really big concern that I have when it comes to student loans. Guess who the collateral is? The collateral is the student. So when you have all these other types of debt, again, I'm in the mortgage industry. When you're talking about mortgage debt, or if you're talking about auto loans, or you're talking about a business loans, each one of those types of loans has collateral. So a mortgage, the home or the real estate is the collateral. On something like an installment loan or an auto loan, well, the vehicle is the collateral. On a business loan, a lot of times the business or a portion of the business's assets are going to be the collateral. And here's the deal. If there ever is some type of financial hardship with all those different loan types, well, the bank is going to go after the collateral. And so, there is something called foreclosure, where the bank forecloses on the loan and seizes the collateral. That is considered a major derogatory credit event. But if that happens, if the borrower defaults on the loan, they lose the collateral. And at that point, there are going to be some negative implications with their credit, and it can impact their credit for many years. But a lot of times they are able to move forward and out of that with enough time, taking those next steps to kind of clear things up. With student loans, though, that isn't the case. If you had a student loan, it can't go into foreclosure. So the only way to get rid of student loan debt is either to, number one, pay it off, or number two, die. And that's the way that things stand right now in 2023. Now, we've talked about and we've heard student loan forgiveness, but again, with this recent legislation, only $10,000 of student loan debt is being forgiven per student, and there are quite a few criteria that have to be met. Remember, the average student loan debt is $40,000 to $50,000. There's over 2.5 million Americans that have over 100,000. Is forgiving $10,000 of student loan debt, is that going to have a life-changing impact? Probably not. For those that did get student loan debt forgiven, that is awesome. I'm rooting for you. I'm very, very excited for that. But that does absolutely nothing to treat the root problem with student loans, which is the fact that this type of debt is, number one, too accessible, and number two, it has toxic loan features. There's no way to get out of it. When you take out that debt, you are not able to get out of it. It is not eligible for foreclosure. You can't file for bankruptcy. And this is also the reason that private banks won't lend on this type of debt, because it's simply too risky. But here's the deal. It's also too accessible. And that is the reason that the cost of education has increased so much over the last 10, 20, 30 years. Anyone can get student loans. It's too accessible. And that is the exact same thing that happened with the housing crisis 15 years ago. Mortgage financing was too accessible. Anyone can get a mortgage. The prices of real estate ran up because of that. And then you had folks getting into mortgages and getting into homes that they simply could not afford, and they did not have the ability to repay, and that entire market collapsed, and it caused a huge recession, and that's what caused the great housing collapse of 2008. And we're seeing some of those same things with the student loan market. It's too accessible. These students and these borrowers don't have to demonstrate the ability to repay, and we need to just make sure that we're doing right by our students, and we're giving them the tools so they can make a decision for themselves if they feel that college and the cost of that is going to be worth it in the long run. And so that is what my goal is to help explain, educate, and teach students on what the pros are what the risks are, so they can empower themselves and make a decision that they feel is appropriate. Now, next week, we are going to chat about some of those student loan repayment characteristics. And it's important because it's not as straightforward as you might think. This is Ben Adams, the American Offset Mortgage, signing off.